So you're interested in trading futures. First, it's important to understand what a futures market is. Futures are standardized contracts for the purchase and sale of financial instruments or physical commodities for future delivery on a regulated commodities futures exchange. Let's take a look at some examples of futures contracts. Many different commodities and financial instruments are available for futures trading. Agriculture futures include commodities such as corn, wheat, soybeans, and livestock. Interest rates are traded in the form of bond and note projections over various time frames, such as 5, 10, and 30 years. Energy markets include crude oil futures and natural gas. Markets included in the metals category include gold and silver futures. Stock index markets such as the S&P 500, NASDAQ, and Dow Jones Industrial Average also have associated futures instruments. Lastly, currency value can be speculated via associated spot currency markets. This diverse mixture of trading instruments provides opportunities to trade in virtually all market conditions. Now that we've discussed what a futures contract is, let's take a look at some unique benefits to trading futures as opposed to other markets, such as stocks or forex. Leverage on futures contracts is created using performance bonds, also commonly referred to as margin. This is the amount of money deposited by both the buyer and seller of a futures contract to ensure their performance of the contract terms. The performance bond may represent only a fraction of the total value of the contract, often 3 to 12%, making futures a highly leveraged trading vehicle. This means that futures contracts represent a large contract value that can be controlled with a relatively small amount of capital. This leverage provides the trader with greater flexibility and capital efficiency. Conversely, increased leverage also creates more risk potential. This leverage and risk relationship should be well understood before trading futures. The majority of futures markets are highly liquid. By providing electronic access to a broad spectrum of products in a centralized arena, markets attract a wide range of participants who trade millions of contracts on a daily basis. This volume makes it easy for traders to execute trades of any size efficiently, without a substantial change in price. If you're familiar with day trading stocks, SEC pattern day trader rules dictate that a pattern day trader must fund an account with $25,000 and maintain this minimum balance. Since futures trading does not include a pattern day trader rule, the cost to fund an account is much lower. Of course, only risk capital should be used for trading, no matter what financial instruments you decide to trade. Futures markets are regulated by the U.S. Commodity Futures Trading Commission, or CFTC for short. The CFTC is an independent government agency formed to foster open, competitive, and financially sound futures markets. The CFTC also protects market participants as well as the public from any fraud, manipulation, or abusive practices. National Futures Association, also known as the NFA, is a self-regulatory organization for the U.S. derivatives industry, which includes futures. NFA has developed and enforced rules, provided programs, and offered services that help protect markets and investors for more than 30 years. Since futures markets are regulated, financial statements are provided, and all client funds are held in segregated accounts. Futures are traded in a centralized marketplace, where all prices are known to everyone. Trading is open, fair, and anonymous. Comprehensive price and transaction data is also distributed in real time, giving individuals a clear view into every single transaction. Trading futures may also offer specific tax advantages compared to other instruments, such as stocks. Discussing these potential advantages with your tax advisor can help you understand if there are tax benefits for you. Now that we've discussed some of the benefits to trading futures, let's take a look at some key concepts associated with trading futures. A unique feature of futures trading is the ability to submit a buy order and be long with our market entry, or submit a sell order and be short with our entry. If a trader expects a market's value to increase, they can go long. Conversely, if the value is expected to decrease, they can go short. Once we've determined the direction we'd like to enter into our trade, we should also understand points, ticks, and their associated values. Each futures market has its own point and tick value. The price of a futures market to the left of the decimal point is known as a point. The smallest increment of change in each futures market is known as a tick, which is a fraction of a point, but varies per market. The E-mini S&P 500 futures market has 4 ticks to each point, so its prices end with 0, 25, 50, and 75. We should also understand the actual contract value of each tick in dollars. Knowing this will help us better plan our trade based on our available trading capital and risk management strategy. As with tick size, tick values can vary by market, so be sure to understand what the value of a tick is for all markets you'd like to trade. The E-mini S&P 500 futures market has a tick value of $12.50 per contract. Once we understand these fundamental terms for our preferred futures markets and are ready to place a trade, we should also consider the price levels at which we'd like to exit the trade should the market move in either direction. This is commonly referred to as trade management or risk management. It is considered best practice in futures trading to have a predefined risk tolerance, known as a stop loss, and also a profit target. Trading platforms such as NinjaTrader offer advanced trade management to automatically place your exit orders as soon as your entry is filled. There are several benefits to getting involved with futures trading, as we covered in this video. Find more helpful information at NinjaTrader.com.